So with that being said, getting into kind of our second topic is, and we'll go with Rocky on this one, due diligence trap and avoiding that bad deal. So talking about some topics, we'll start off with what's the most common math mistake buyers make when they look at the seller's numbers.
So I guess the question is, are the seller's numbers trustworthy? The first thing, how do you know that they are real? And one of the things you'll realize is when someone goes to sell, they've spent a couple years fixing up the house, so to speak, right? They make things look pretty. You've got to ask yourself, is this real? And that's a whole process to go through. Also, comparing what the financials say to what the tax return says, they match up or do they not match up? Because if they're lying to the government, they telling you, like, where is that trust coming in? The other thing is you really have to understand the balance sheet and how the balance sheet has changed over time, because you can hide a lot of mistakes and a lot of problems on the balance sheet. And if you don't know how to read that or understand that, you might be getting yourself into a situation that isn't perfect. In other words, I remember I was looking at one deal, it was a car wash. And when you looked at the balance sheet, you realized the equipment was super, super old. And so think about today, all these new shiny car washes, and you're running a car wash that's 15 years old. Sure, it was making money, but how quickly is somebody coming in across the street going to put you out of business? So it's being able to understand that and to know what is it going to take for you to run the business after the fact.
Quickly after you buy it, you have to buy it again because you have to replace all the equipment. It's interesting. One of the big problems I run into when I'm talking with business buyers is many of them will have formal business education. They'll have like a business degree or something. And when you're in business school and you learn about accounting and stuff, you typically are looking at like public companies, and all these big companies have audited financial statements, and we can be pretty certain that they're accurate unless, there's like an Enron situation or something. When I work with my clients on small businesses, we always start with the assumption that the financial statements are filled with errors, because in almost every case, the people who are inputting things into QuickBooks are not professionals. It could be employees entering things like sales or purchase receipts. It could be, the owner's spouse is spending some time in the evening kind of reconciling things. And then maybe at the end of the year, to your point, Rocky, about financial statements matching tax return, it is normal for an accountant to take the internally prepared financials and then do year-end adjusting entries and things to get the tax returns ready, and to hand the owner the list of adjusting entries, and for the owner to never put them into QuickBooks. And so what you end up with is compounding errors year over year over year that increasingly cause the books to mismatch with the tax returns, which is one of the reasons why they may not match. And so all of these problems are seen everywhere. And one of the other big problems is that small business owners rarely have an understanding of how to create and enforce any kind of accounting policy. So we see this a lot. I saw it just a little while ago, a company that does window replacements in homes. And so they had this huge amount of receivable. It was like 2.5 months of sales, which doesn't make sense, because what that means on paper is that people are taking 80 days to pay. But the reality was that they didn't have that kind of receivables. What they were doing is they were inputting the transactions as a sale when the homeowner would make the order and give an initial deposit. And so it was showing up in the system as a receivable, even though the money had not been earned. And they had to wait 5 or 6 weeks for the factory to make the window, for it to be delivered, and then for the guys to go out and install it. And then, shortly after installation, they were being paid for within normal commercial terms. But their reporting was way off because the people doing the bookkeeping did not have any idea of what a proper accounting policy should look like. They were just doing it the easiest way, which was to record it as a sale with the deposit being a partial payment, which, the proper way would have required a couple of entries. So this kind of thing is very common in the world of small business. And without understanding what to look for, you can easily get into trouble. It's why it's important to have a team of people helping you who are familiar with small business financials, to extend the analogy of doctors, brain surgeons and pediatricians have the same medical license. Well, CPAs are out there working with people on different tax returns and financial statements, but different accountants have experience in different lines of work, depending on who their clients are and what size of businesses they worked for example. So it's important to build a team that has relevant experience when you're doing one of these deals.
Yeah, great stuff. Great takeaways. Agree with all of this. Just to add, though, at a higher level emotional component to the conversation, the thing I always recommend, and I say it to myself, is related to what happens in real estate. Be careful not to fall in love with the business before you finish the due diligence. And I've caught myself doing this, right? I want this business so bad for other reasons. And so I'm willing to overlook things that might be there if I were to look. But a couple other tactical things, and I just had this come up with a client recently. They're at the 11th hour, and it's just now that they're visiting, assuming or assignment of the lease of this physical space. And that should have been something that should have been looked at way earlier on. It may actually kill the deal because the landlord is seeing an opportunity. It turns out it was on a month-to-month basis. That should have been something that should have been identified early on. So my point there is those other commitments, and then the obvious one that I'm sure we all have opinions on, which is how much is the business based on the owner, whether it's relationships with clients or key partners, or even the staff. As soon as that owner leaves, there goes the key staff because they only wanted to work for him or her. So those are some other things to think about from a due diligence perspective, Giuseppe.
Hey guys, thanks for listening. I hope you're enjoying the show. As a thank you for being a valued listener, wanted to offer you a free copy of my book, Franchise Freedom. This book was written back in 2020, and it's my exact blueprint in helping you find that perfect franchise. I wrote it based off my experiences and wanted to pass that along to you. Want to chat today? You can book a call directly on our website, top right side of that screen, and you can schedule a 20-minute call. We'll dive into if a franchise is a good fit, help you get qualified, and figure out what that perfect franchise match may be. So I hope you take me up on my offer. Once again, Franchise Freedom. Download the book today for free or book a call with me directly, and we'll help you bypass all that information you find online. Most importantly, figuring out if a franchise is the right fit, and then figuring out what that perfect franchise looks like. So thanks again for listening to the show, and back to the show. Yeah, and this is a conversation I had with David on the show. I think it was last year. And one thing we talked about was when you're looking at the financials, first off, I've noticed in 20 years of owning businesses, a lot of business owners don't know the difference between EBITDA, cash flow, net income, profitability.
Sure. Yep.
They're just throwing numbers and they're just looking at maybe their pay, but not looking at the combined efforts of everything combined. But when you look at maybe a business for sale, they've been up and running for 20 years, or you're looking to acquire, they may not have any debt. So they may be paying themselves $100,000, another $100,000 in net income, which is great. But when you go and take over that business, you have to factor in, obviously, your loan, if it's an SBA loan, what that loan payment's going to be. Your cash flow can easily be cut in half, factoring in what the debt is on any loan. If it's a brand new franchise, if it's an existing business, you want to factor everything in and do your own numbers. What is, at the end of the day, your break-even number? $10,000 a month, great. How many jobs or how many clients or customers do I need in order to break even? So always run the numbers based off your scenario, specifically how you're going to fund it, which is crucial. Which brings me to, what are your guys' thoughts? And this could be franchise or in the franchise disclosure document, or just in analyzing a non-franchise business. What are certain red flags, things that come up where you're like, hold on a second, this is something that really needs to be addressed right away? We've seen some red flags, but I wanted to get your take on things where you're like, wait a second, let's place a hold on due diligence here until this is figured out.
I think we've maybe already touched on it, but it's that discrepancy. At a minimum, I'm going to look at your financial statements and try to match those up best we can to your POS system, if there is one, to your bank accounts. And then to the point that Rocky made, if then I go, oh no, because some of that stuff we don't put it on the books or we pocket it or whatever. Boy, as Rocky put it very well, if you're not being honest to the IRS, how honest are you being with me? So I initially look for those kind of obvious red flags.
A big tool in looking at any business, whether it's a new franchise with some kind of statement saying this is what the business could do, or if it's an existing business, you get yourself some benchmarking data. So some common sources for this would be RMA, Risk Management Associates. Big libraries and university libraries often have a subscription. The Canadian Industry Canada puts all of their data of a similar nature for free online. It's very similar to American data. And basically what they do is they break down businesses by category. They break them down into quartiles by either revenue or profitability. And you can see the average income statements and balance sheets according to tax returns. So if you're looking at some kind of exhibit showing you what the business should do, you should go examine a benchmark business of the similar quartile, similar size, and see what they really do, and just look for things that might be missing. Is the cost of goods sold way different than what you're being told? Are some of the overheads that's different than what you're being told. Or there are things like insurance that are way higher in the actual example than what you're being shown in the exhibit, just to make sure that something hasn't been forgotten. Let me tell you a quick story. There was a lady who spoke to me after she did a deal to buy a beauty salon, and these were hairdressers cutting hair, and they were working on commission splits. In her financial forecast, she put that they would be taking 45% of the business's revenue for hairdressing. And she worked with that model through the whole thing. But what she didn't realize is even though they were taking a split of commission, they were still employees, which meant that all the source deductions still applied to them. So like all of the, public insurance, the payroll taxes, et cetera, which amounts to, in most states or provinces, between 8 up to 11% of what the person's paid. She forgot that. And that added up to half of what she was banking on for her cash flow. Just gone because of that one little mistake. If she had looked at benchmarking data, she might have had a clue that her numbers were off for some reason. And with the right question, she probably would have uncovered the reason.
David just showed how one missed line item can blow up an entire deal. But that's just the beginning. Next, the panel reveals exactly how to catch red flags using bank statements, benchmarking data, and a brilliantly simple deposit test that David calls the fishy deposit method. You don't want to miss this one.